19, and we have some big exclusive news coming in. And watch for the Bank Nifty. We've got Lata joining in with some thoughts of what really is going on in terms of the conversation that bankers are having with the Reserve Bank of India on several issues, including how the UDAY debt, the DISCOM debt should be treated, and how some of these SDR or strategic debt restructuring accounts should be treated. Lata, thanks for coming in, and these are both such critical issues. So let me start by first asking you about UDAY. What seems to be the sense from the central bank on how they look at it?
The central bank's sense seems to be, and this comes from bankers really, is that they have no problem with loans being taken over by the state governments. That is perhaps a more sturdy borrower, and if some mark-to-market losses have to be borne, so be it. But what is being kept with the DISCOMs is the same borrower getting that loans yet again. It is being rolled over. The correct word for that is restructuring. So for the restructured part of the loans, banks will have to provide, like any other restructured loan. Since restructure doesn't exist, it is either a standard loan or an NPA. This will be treated as NPA, and to that extent, that will have to be provided for as a restructured loan. As well, bankers indicated that that base rate as the interest rate fixed for those bonds is something both banks and RBI are uncomfortable. That should be a market-determined or lender-borrower determined rate of interest. Why should that base bond rate be indicated by the government? Was another point of discord. But more importantly, there is going to be another set of provisioning which probably the market didn't know, that 25% of DISCOM debt has to be provided for.
So this would be, I'm assuming, a serious number, because it's 25% of the total DISCOM debt that's available that will remain with DISCOMs and will be converted into
It
these
is a
bonds.
serious number. It's, I think, 2 lakh crore or something, which is the total debt of all DISCOMs.
Okay.
Now, we should remember 75% is taken off.
Sure.
And in the remaining, only 9 states have agreed. So let's not run away with a very big number.
Okay.
Of those 9 states, 75% goes away. 25% of that is distributed over some 25 banks. So it's not as if it's going to slap you in the face, but in principle, that is a rolled over loan and has to be provided for.
And that's something that the market didn't have in mind. Also, what are the conversations that you would know are happening over the strategic debt restructuring and the tweaking that we've been reporting that might happen?
Yeah, this actually, Ritu Singh had already reported that the Reserve Bank is asking or is likely to ask bank to provide for the SDR loans. What we now gather is the banks see the justice of that case, because if you don't provide for those loans, you have a higher profit and therefore you declare a higher dividend. At the end of 18 months, you declare, oh, my profit should not have been as big because I should have provided for that. So the instruction of the regulator is, why don't you provide at least partly for it, so that you end up paying lesser taxes and dividend. And in the end, you can always write back the provision if indeed you find another promoter. That seems to be the argument that the Reserve Bank is placing. However you look at it, bankers are agreeable that there is going to be higher provisioning, but it will not be backbreaking because it's going to be spread over 6 quarters. And the Reserve Bank is going to keep in mind what are the profitability trends and the capital available with the banks during the 6 quarters.
Okay, so a higher payout probably for sure, but it will be gradual, as Lata's pointing out. Thanks so much for those details.